Business valuation is a core skill in business plan development. It helps us understand what a company is truly worth rather than rely on assumptions or appearances. That value matters to founders making strategic decisions, investors evaluating opportunities, and analysts comparing potential outcomes. The central question is not simply what a business earns today, but what its future performance, assets, risks, and opportunities are worth. In this presentation, I'll explain the key approaches used to calculate that value and why the process is so important. Business valuation matters because it supports decisions well beyond a company's sale price. When raising capital, a valuation helps investors understand how much ownership their funding represents. In a purchase, sale, merger, or acquisition, it provides a basis for agreeing on fair market value. Valuation is also important for legal and tax needs, including estate planning, divorce proceedings, and compliance. Most importantly, it gives leaders a clearer view of the business's worth, helping them set growth goals, measure performance, and compare their position with competitors. Business valuation is built around three complementary perspectives. Asset-based approaches focus on the balance sheet, estimating value from what the company owns after subtracting what it owes. Market-based approaches look outward, comparing the business with similar companies that have been sold or are publicly traded. Income-based approaches look forward, estimating future earnings and translating them into today's value. Together, these methods provide different lenses on the same question. What is the business worth, based on its assets, its market context, and its earning potential? Asset-based valuation focuses on what a company owns, rather than primarily on its future earnings. The book value method calculates net asset value directly from the balance sheet, using the recorded value of assets and liabilities. The liquidation value method takes a more conservative view, estimating what those assets might bring if sold quickly, which is typically less than book value. These methods are especially useful for manufacturing companies, real estate businesses, and holding companies with significant tangible assets, or when a business may be distressed. Market-based valuation estimates a company's worth by looking outward at how the market values similar businesses and transactions. Comparable company analysis, or comps, starts by identifying publicly traded peers, then applying relevant multiples to the company's own metrics. Common examples include price to earnings, enterprise value to EBITDA, and price to revenue. A second approach is precedent transactions, which examines what acquirers recently paid for similar businesses. These deals may include a control premium because buyers are paying for the ability to direct a company. The DCF method values a business by connecting its worth to the cash it is expected to generate in the future. The process starts by projecting cash flows, then choosing a discount rate that reflects risk and the time value of money. Next, we calculate terminal value to capture value beyond the projection period. Finally, we discount those future amounts to present value. The key idea is that future cash is worth less today, and risk determines how much less. This slide puts the discounted cash flow method into practice. Future cash flows are converted into today's value using the discount rate, or WACC, while terminal value captures value beyond the explicit forecast period through a sustainable long-term growth rate. In the 3-year example, cash flow rises from $100,000 in year 1 to $140,000 in year 3. Discounted at 10%, those amounts contribute $90,909, $99,174, and $105,184. The total present value is $295,267, which represents the combined value of the forecast cash flows today. Valuation multiples provide a quick way to compare how the market values companies, but they should never be viewed in isolation. Industry and growth profile are the key drivers of those differences. High-growth sectors often command premium multiples because investors are paying for stronger future potential. By contrast, capital-intensive or cyclical industries typically trade at lower multiples, reflecting heavier investment requirements or less predictable performance. The right benchmark, then, is always one that fits the company's industry and growth characteristics. When valuing a startup, traditional financial metrics are often limited, so qualitative and forward-looking methods become especially useful. The Berkes method assigns up to $500,000 across 5 areas: the idea, prototype, team, strategic relationships, and product rollout. The scorecard method compares a company with regional peers, weighting factors such as team strength, market size, and competitive advantage. Finally, the venture capital method works backward from an expected exit. Its core formula is pre-money valuation equals post-money value, divided by 1 plus the target return on investment. Higher valuation multiples typically go to businesses that investors can understand, trust, and scale. Predictability, scalability, and defensibility are the core drivers. Predictable revenue comes from strong recurring or contracted sales, along with a diverse customer base and low churn. Scalability is reinforced by an experienced management team that stays with the business and can execute consistently. Defensibility comes from proprietary technology or a strong brand moat. Finally, healthy, improving profit margins show that growth is translating into stronger economics, not just higher revenue. The key takeaways are simple. Choose the right valuation approach and use DCF as a foundation. Context shapes every method and multiple, while recurring revenue, strong margins, and a defensible moat increase value. Ultimately, valuation combines rigorous analysis with sound strategic judgment.